amid growing concerns about economic growth.
Consumer spending was
As
soft.
expected, cut interest rates another quarter point.
We are following breaking news. All three major American stock markets have closed down.
Bitcoin rose 10%.
Even gave the stock market a temporary second win.
The market reaction, it was kind of nonplussed.
Tariffs going into effect tomorrow.
But the NASDAQ was also.
Investors will be watching closely for more clues about the direction.
It's time to tune out the noise and tune in to great information with A Steward's View. Expect valuable economic updates, investing techniques, and planning concepts that move you to be wise and decide well. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time. You can listen to this podcast and previous episodes at astewardsview.com.
Welcome back. I'm Aaron Kolkman. That's Chaz Louder, and this is A Steward's View. So glad you joined us again. Remember to visit this and previous episodes online at astewardsview.com or on your favorite podcast platform. Now, let's take a look at what happened last week. The S&P 500 and NASDAQ Composite continued their push into record high territory, rising 1.5% and 1% respectively. Positive momentum from corporate earnings, reports, and trade negotiations outweighed ongoing tensions between the White House and Federal Reserve. The Russell 2000 rose nearly 1%, while international developed markets outperformed the U.S. All 11 S&P 500 sectors gained ground, led by a 3.5% jump in healthcare. Crude oil and gold prices fell, while Bitcoin was flat and Ethereum rose another 5%. U.S. Treasury yields, meanwhile, eased slightly, with the 10-year note settling near 4.4% ahead of the Fed's next rate decision. Mixed signals on the tenure of FOMC Chair Powell persisted after President Trump visited the Fed's headquarters on Thursday. On the trade front, a deal with Japan was announced that purports to lower tariffs on auto imports, while the European Union was optimistic that an agreement with the U.S. could be reached before the August 1st deadline. Turning to economic data, weekly jobless claims totaled just 217,000 as the U.S. labor market remained on solid footing. Domestic business activity accelerated this month, but companies sought higher prices for goods and services and remained concerned about tariffs and government policy changes. The S&P Global Flash Composite PMI Index rose to 54.6, boosted by a surge from the services sector. The prices paid index edged up to 61.9 from 61.2, while the price gauge for services inputs jumped to 61.4 from 59.7. The housing market continued to struggle under the weight of high mortgage rates. Existing home sales fell 2.7% last month, as supply jumped 16% year over year. The median sales price, meanwhile, reached $435,300, a record for the month of June and the 24th straight month of annual gains. The inventory of new U.S. single-family homes rose to levels not seen since 2007, forcing builders to cut prices to attract buyers. Overseas, Japan's Prime Minister Ishiba vowed to remain party leader despite losing control of the upper house in Sunday's election. The upheaval may convince the Bank of Japan to reconsider its plans for raising interest rates. Inflation pressures, meanwhile, ease slightly there, but remain above the Bank of Japan's 2% target. The European Central Bank did leave rates unchanged, and its modestly positive economic assessment suggested that future rate cuts may not be in the offing. Eurozone flash PMIs reflected marginal growth this month. So investors are getting more of a bull market across multiple areas of the U.S. and foreign equity space. So that's to say this is a broad advance in equities that we've been seeing in weeks past. We're setting new records. There's plenty of headlines about that. These are the fun kind of headlines to get, right? When we started this program back in March, that we didn't have the same kind of headlines then. We're seeing the kind that everybody can enjoy, and then they open their statements here at the end of the previous quarter, June 30th, and say, oh my goodness, what growth did we get? So not feeling like a moderating growth period, but keep in mind the second quarter was a sort of a recovery from that March-April period where we had a lot of volatility and downside pressure on equities globally and in particular in the U.S. So I'm encouraged to see price recovery and continued growth. Keep in mind, we're looking at year over year when we talk about expectations for growth. We're not really talking about week over week or quarter over quarter. So, but yet good news. So really glad to see that. Previous weeks we've spent a lot of time, and I want to confess we didn't stay on track last week. OBBBA was so big and so important. We spent a lot of time looking at that, and we'll come back to OBBBA at some point in the future. There's a lot there that we didn't really unpack as far as the effects on investors and the effects of taxpayers, people that are not investors, people who are just doing their annual filing, and how that might be impacted. So there's a lot there to talk about yet, but I did do that sidestep on purpose last week just to make sure we acknowledged, hey, this really big thing happened on July 4th. And if you want to talk about that, by the way, with A Steward's View, please do visit astewardsview.com, or you can find us on Apple, Amazon, or Spotify, and engage with us, your thoughts about One Big Beautiful Bill Act. So the path we were on before last Monday, though, had to do with total return investing and consistency investing. Okay, and the drive there, the lead up, if you will, to what I'm getting at in this program, at least in year one, is the core for investors to consider, not as to their holdings, not as, you'll hear me say, this is not for stock tips. This is not for dividend investing ideas. Okay, we're not here to give you the flavor of the month. What we're here to do is to help you fund goals as efficiently as possible. That's in financial terms. Right now, in life terms, we want you to have some wisdom to apply to your decisions, right? And to do that well. So being wise and deciding well is the fruit, if you will, from this dialogue that we're having together in regards to your financial plans, in particular, funding your goals. So this piece about investing that we've been on has had everything to do with how to fund goals efficiently. We've talked about what total return investing is. We've talked about what it means to aggregate, and then what it means we started getting into optimization. Okay. And I sort of left open this conversation about measuring that, which is sort of the end cap to all of these pieces or these sessions that we're doing together. We stopped and talked about fees as well, as sort of a big important topic that often gets in the way. Today, I want to do that again on a different topic as we continue on this original path. Okay. And this path of funding goals, this path of thinking about total returns, right? Which is what? Taking all returns in a year from all sources in the portfolio, which is capital gains, interest, dividends, and just rising prices. Okay. And looking at the total of all of that, typically reinvested, that's how it's calculated, and what it means for the goal or goals that's being funded. So that is what total return investing is. Doing that in a consistent way, we said, requires aggregating or bringing together assets from across a household, right, or a family, and then we're getting again into the idea of how we might measure that. Okay, and we've even gone as far as talking about tax treatment of returns. We've talked about the Sharpe ratio, right, risk and reward both, and I've made reference to somehow my firm does things, but this is not a program that is designed to sell services or it's designed to sell products. This is a decision-making program for people who are focused on their decisions in ways that they might enhance what they're doing, however they're doing it, as self-directed people, as people who are working with an advisor, or whatever in between. So that's the heart of the matter. For today, the topic I want to touch on in that context is passive versus active investing. Okay. And this is an age-old debate. It's about as political as anything gets in finance, in investing in particular, because it tends to get looked at as an either-or. And so you have this, well, I'm going to be indexing. I'm going to be a passive investor, right? I'll go, Vanguard is the famous powerhouse for this. I can go and set up an account at a place like Vanguard, and I can pay very little to have a series of computers track whatever's going on in the areas of the market that I want to be in. Okay. And it didn't cost me much, right? I mean, 10, 15 basis points, 0.1, 0.15%, something like that, for some of the least expensive areas that you could buy, okay, and hold. So what do I get when I do that? Let's come back to that in the second segment. But what's the alternative? The alternative is active investing. Okay, well, what does that mean? Active investing just means that we have people and computers, right? Now, where does AI come in? Boy, isn't that a conversation? We're going to keep it simple for right now and just say, I'm going to hire people or a team of people to make decisions to do something beyond the index. Okay, so I'm going to pause here in just a moment, but we're going to go now into a stage of this program that I want to call beyond returns, right? And we're going to focus on value, not just numeric prices and returns, not just the numbers, but the value of what we're getting as investors. So when we come back, active investing, again, we've got people and computers making decisions, trying to add value, right? And then the indexing or passive investment, we just have an inexpensive kind of a copy of what's going on in a given market anywhere in the world. Exactly the risk, exactly the return, nothing more, nothing less. That's what we would expect from indexing. And then the active side, again, we would expect to have something better, right? Now, what does better look like? What is value in this conversation? So let's talk about that when we come back, and we'll just take a break right now.
Rural Music Fest is back, and this year features Seth Schluter, August 22nd through the 24th at Redemption Hill in Isle, Minnesota. Sing along with Sanctus Real. It's the 4th annual Rural Music Fest with bounce houses for the kids, food trucks, raffles and prizes, and music from over 15 Christian artists like Grammy Award winner Dante Bowe. And closing this year's Rural Music Fest, Colton Dixon. It's the Rural Music Fest, August 22nd through the 24th. Learn about camping, volunteering, see the entire lineup, and RSVP for this free event at ruralmusic.org.
And we're back. So in the first half, we talked about the idea that indexing or passive investing versus active investing is an either or. If I take out the word versus and I look at it as a both and I say, well, we could do both depending on, right? Depending on what? Well, I submit to you that in 25 years of doing this line of work, the biggest, best answer I have to that question from all the research that I've looked at in 2.5 decades is it depends, right? Isn't that a famous response for a planner or a portfolio manager to give, Chaz? Right? You ask them a question, they say it depends.
There's always a, well, what if, or a clause, or maybe, or yes, but. Yeah, that's actually better. Yes, but.
And then, okay, great. So if we take out the word versus and we say, all right, well, it depends on the area of the market that we're looking in. Okay, so if I'm looking in the U.S. at large companies, I mentioned back in March, there were 2 names in the past, 4 decades of portfolio managers that have consistently, year over year, beat the S&P 500. Okay, and that's Peter Lynch and Bill Miller, incidentally. Okay, maybe you know them. My bet is that you don't. The point I'm trying to make is that the beat on return, which is what I was referencing there, I didn't say that, but the beat on return that those 2 portfolio managers accomplished beyond the S&P 500 was very slight. They were active investors, not passive. It was very slight, and it's very rare to find someone that could do that. Okay. So I've already said in previous episodes that when we're just looking at return, not risk and return, we're really missing half of the equation. Okay. But to keep it simple, you would have paid more to have Bill Miller or Peter Lynch working as the portfolio manager of the fund. Peter Lynch ran the Fidelity Magellan Fund. Bill Miller, I think it was the Legg Mason Growth Fund. Could be wrong about the name. Whatever the name was, you paid more than 0.1 or 0.2% to have these active decisions being made to try to do something better than what the index offered. Okay, so when I say it matters what area of the market you're in, What I'm referring to is how efficient that market is. So in an efficient marketplace like the U.S. large company marketplace, measured by the S&P 500 typically, that marketplace is very difficult to beat on return. That's why when I hear, stock tips or I hear dividend investing ideas, and is there value? Can so and so go out and find a bull market for you? Sure. That's just it's a short term, more speculative conversation. Okay, this particular program is designed for long term investing, not short term stuff. So in the long run, when you're trying to fund goals and not having to do all this yourself, and you're having to make a decision between, well, do I hire a computer on the cheap or computers, or do I hire people, right? What we're saying is it could be both, right? Instead of an either or, right? It's almost a political thing to say, well, I'm indexing or I'm active investing. And then you hear more than just, well, what area of the market are you? And you hear, what kind of market are you in, right? So, for example, the more volatility that we have, the more active investors can do well, right? Why? Because if you hire an active investor to run their show, their fund, their ETF, whatever their vehicle is, they have more opportunity in a volatile market to get price arbitrage. Okay, so but with the speed of markets and the high efficiency of markets, where all information is available almost, instantly to everybody, there's very little opportunity to know something. In fact, it's illegal to know something. It's against industry regulations to know something, in particularly in the space we're talking about, and trade on it, right? So we're dealing with the same information that everybody else has with whatever our tech setup is. The moment something is known, the market adjusts. Okay, we're dealing with very visible companies who have public quarterly filings that they're doing, and it's very hard to find opportunities. Can you find it in a given month in a volatile market? Absolutely. We can find a great dividend investing idea on a stock that's down that continues to pay a dividend. Yes, and the yield sounds sky high, and we pile in, and the price goes up, and now we've got a great total return story. Okay, my question is, how'd you do year over year with that? Okay, that's what I really want to know. In 3 or 5 years, which is actually a long time, how'd you do with the flavors of the month? And, if you're a self-directed person that's doing day trading, no problem. Let's look at that, and then let's look at the longer-term holds that we're talking about here on this program, and then you can make more decisions from there about what you're really going to do. I have a very full practice and a number of families that are doing this on the side, this more speculative thing that isn't necessarily, it's just short term. Okay. And that's why it's high risk, right? There's risk in trades. And so when you're going out and you're trying to find an opportunity in a volatile market, just like an actively invested fund in a volatile market, there's more arbitrage opportunity as the market gyrates, right? In a market that's very steady, like we had from 2009 to 2000 and really December of 18. It was March of 09 to December of 18. Longest bull market in the history of the U.S. anyway. That marketplace was a very steady climb. Okay, there wasn't a lot of volatility. And so the arbitrage opportunities, and I'm, again, speaking about U.S. large company stocks, it was minimal, right? So you could make a good argument then, what kind of market are we in? We're in a slow and stable, upward moving bull market. Okay. Well, it's easy to say, let's index. Okay. What I'm trying to impress is we should know what area of the global marketplace we're invested in. We should know what kind of market we're in. Yes, that's all true. But after that is where the opportunity lies to do both and. Okay. So if you're in an efficient area of the market or a relatively stable area of the market in the current season, let's call it, those are arguments for index investing, right? And they're good. They're good. Why not save cost, internal fees? Talked about fees on this program. If you can, and if you're likely to get exactly the risk and the return of the market on the cheap, sure. I'm for that. Why wouldn't you be? Okay. Now, if we go to small companies where not everything is as widely published or known, or we go to foreign emerging markets where even fewer companies are, required and reporting, and therefore even less is known by investors, you can start to see where these less efficient areas of the market have more opportunity for the active investor. And I'll say another word or two about active investing. When you have people involved that are decision makers, again, I haven't factored AI into this analysis for today, but they're looking at research. They're talking to corporate leaders. They're looking at geopolitical context. They're having conversations together, and then they're coming to a conclusion on how to allocate capital. That is an active method of investing, which plenty of computers are involved, but it's a hands-on approach. Okay. The areas I just mentioned, small companies, 1 billion or less in market cap. Think of the Russell 2000 in the U.S. Foreign companies in emerging markets like India, Russia, China. You hear about BRIC, Brazil. Those countries, these emerging markets, much less efficient, much more opportunity for active investors. So there's a reason or an area in any market, frankly, but especially in volatile times. They're already going to be volatile, by the way, compared to U.S. large companies. But I digress. Those are areas where you'd say, okay, well, maybe I want active investing in my portfolio. Okay. So these are examples in real life examples of the both and that exist with indexing or passive investing and then active investing. Okay. So what I do isn't really the point. What I'd like to leave with investors is that to consider the talking points from this particular episode, and then above that, consider where in the world you're invested and why. Those are the conversations I would like to encourage you to have. And the reason is that second part, when you're looking at a well-diversified, and I'm arguing for a geographically global portfolio of assets, indexed or active, either one. I'm suggesting look at both. Vehicles, by the way, mutual funds, ETFs, doesn't really matter. What matters is who you're hiring or what you're hiring. Okay? Whose computer is it or what people are they, right? But look at the areas that you want to be invested in first. Okay, why? Because you are going to be quite disappointed if you end up with I'm going to use Fadir's examples. We have 15 areas of the global market right now that we've stayed invested in this year. Okay. If all of those or most of those areas of the global market move together, what happens when, markets are down? They all go down at the same time. Okay. Well, you wouldn't buy a car that had cylinders doing that. You would want a car with cylinders that move at different times. Amen, Chaz? Okay. So the finance term is covariance. The investment term is correlation. Okay. So what we want is to be in the world, anywhere in the world where we can find lowly or negatively correlated areas or asset classes to invest in. That's the first thing to think about, right? Unless you're just content saying, well, I'm going to have everything go up at the same time, everything go down at the same time. In which case, I would say save yourself a lot of work. Go ahead and just buy, a bunch of big names, follow 30 or 35 stocks, concentrate your portfolio, and take that, equity style ride, which is totally fine to do. In the long run, you're going to do well, historically speaking. So that's all good, but let's not go to the trouble of building a global portfolio if you're not going to look for areas of the market that behave differently from one another. And that gets more about total return investing. So I'm looking at that. I'm saying, let's go global. Let's diversify the areas of the market that we're in, right? And then choose our vehicles and our managers from there, whether it's, passive, index, or active. Okay. So that's a lot about investment process, but it goes right to the heart of why indexing and active investing and fees associated are really not the point, right? The point, there are multiple points along this path that we're on, getting to how to measure value add or get beyond returns. And by the way, before we close, I want to mention on stewardsview.com, you can pick up a white paper series that talks about passive and active investing and getting beyond that either or view. So I'll mention that now. Please do take a look at that. It's about a 10 or 12-year-old white paper now, but it's a 5-part series, and one of those parts has this exact conversation in it. And I think it'd be a help to you if you're trying to figure out, how much am I going to pay, and should it be, indexed or passive? Should it be active? Should it be both? So those are some thoughts, and I just, I can't miss these conversations. We've promised this exact conversation for a while now, but we'll head in weeks coming. We'll head further down this path and get talking about how we measure value add in terms of particularly advice received, but all of these pieces put together. So with that, I don't have anything else. I do want to zoom out and take a look at the week ahead. Chaz, anything else before we do that?
It's not exactly on topic, but I've noticed you've said this the last couple of weeks. Maybe it's just because of a new market readout, but you've been mentioning Ethereum lately. And I've been meaning to ask you about it, but there's never been a point. So if you want to say anything about why you've been mentioning that lately, I'm glad you brought that up.
I don't have a short answer, so I'll just say I'll blame this one on the content provider, which is Schwab. So
that's fine. Until next time.
I'm actually thought about having one of them come on and talk to us about some of this. So thank you for the question. Let's come back to that one. The week ahead, it's shaping up to be potentially one of the most pivotal of the year thus far, with a jam-packed mix of central bank decisions, critical economic data, and major corporate earnings announcements. Friday's deadline for tariffs takes effect, also looms large. In the U.S., the Fed is widely expected to leave interest rates unchanged on Wednesday. Attention will be focused on any forward guidance as conflicts with the administration, that's the Trump administration, escalate. Fed funds futures currently imply around a 65% possibility of a rate cut in September, a number that could swing significantly depending on the tone of Jerome Powell's statement. The first estimate of Q2 GDP also arrives on Wednesday, with projections for 2.5% growth. The monthly employment updates are sprinkled throughout this week, culminating in Friday's non-farm payrolls. The core PCE price index, ISM manufacturing PMI, and revised consumer sentiment figures are the other main releases to watch. Earnings reports from mega caps like Apple, Amazon, Meta Platforms, and Microsoft have market-moving potential, given their outsized influence on U.S. equity indexes. On the international side, the Bank of Japan is expected to keep rates steady as political pressure may mount following last week's election results. Rates are also expected to stay on hold in Canada as the country continues to seek a trade deal with the U.S. Finally, inflation updates from Australia and the Eurozone, along with China's PMI releases, round out the overseas agenda. With that, it's been such a pleasure to be back with you. I do hope this session has been a benefit to you and others you decide to share it with. We invite you to connect with us online at astewardsview.com. That's astewardsview.com. From all of us at A Steward's View, we look forward to connecting with you again next week. Until then, please do be wise and decide well.
You've been listening to A Steward's View. To learn more about Fidare Advisors or speak with Aaron, visit fidareadvice.com. That's FIDERE advice.com. To listen to this and other episodes of A Steward's View, visit astewardsview.com. A Steward's View is brought to you by Fidare Advisors, a registered investment advisor offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plan for families it serves. Fidare maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions and is for informational purposes only. Fidare and its representatives do not offer tax or legal advice through Fidare. please consult the appropriate advisor. Fidere Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidere, please visit fidereadvice.com. That's FIDERE advice.com.